Okay, let's be totally honest. If you've been relying on single entry setups, crossing your fingers, and just hoping for the best, well, you're basically playing a really dangerous game. Welcome to this explainer. Today, we're completely breaking down a multi-entry strategy, which you've probably heard called scaling in. We are going to explore how shifting your mindset from a risky, kind of gambling style approach to calculated position building will fundamentally change your relationship with the market. Because, when you stop throwing your entire position size at a single random price point, you literally start unlocking a whole new tier of consistency. Look, we've all been there, right? You see a massive breakout on a chart. Maybe it's Bitcoin, maybe it's gold. Your indicators are flashing bright green, the momentum feels unstoppable, so you commit your entire position size all at once. And then, the absolute inevitable happens. The market pulls back to test a lower support level. Suddenly, you're sitting there severely underwater, sweating out a massive drawdown. It's just a reactive, anxiety-inducing way to trade that leaves zero room for error. You just end up staring at the chart, praying for a miracle bounce just to get back to break even. And why? All because you demanded perfect timing from an entirely imperfect market. So we have a really exciting roadmap for this explainer. We're going to cover 1. The all-in trap. 2. What is scaling in? 3. The step-by-step setup. 4. Managing risk and volatility. And finally, 5. The psychology of scaling. All right, let's jump right into section 1, the all-in trap, and why it's such a risky approach. The traditional all-in model basically demands flawless execution from you. You are demanding that the market respects your exact entry immediately. It's like building a house on a super fragile foundation. The scaling strategy, on the other hand, completely reframes this. By building a pyramid-like foundation over time, it averages out your entry prices and actually turns natural market volatility into an advantage rather than a threat. When you assume going into a trade that your first entry will probably be wrong, or at least a little early, you totally protect yourself against the natural ebb and flow of price action. Moving on to section 2, what exactly is scaling in? Let's establish what this gradual entry strategy actually looks like. Simply put, scaling allows you to enter a trade gradually so you can lower your average entry price and stay fully in control. Instead of firing a single bullet and hoping it hits, you deploy your capital strategically. You take a really small initial position. Then, if the market pulls back, you add to it at predetermined support levels. You are actively engineering a situation where you can weather a storm, secure a way better average price, and still come out in profit. Think of it like probing the market. You're just testing the waters with a fraction of your risk. If the trade immediately goes your way, hey, you've got skin in the game. But if it dips to a logical structure level, you're perfectly prepared to build your position at a discount. Okay, section 3, the step-by-step setup. Let's look at how to actually build this position. Using some awesome frameworks from TradeStation and Holoprime, we can see a really logical, chronological life cycle for building a position here. First, you make a small initial entry on confirmation. We're talking about a clear structure break or a strong bullish engulfing candle. Second, you make a subsequent entry if the price pulls back to retest a lower support zone. And third is pyramiding. This is where you program your strategy to add even more weight as the trend continuation is fully confirmed. You literally make the market prove itself to you before giving it your full position size. Maybe your momentum indicators, like the RSI, are resetting right on that pullback, which gives you a textbook condition to deploy your second block of capital. You're systematically turning one big trade idea into multiple deliberate actions. To really ground this concept, let's look at a specific strategy from Holoprime using highly volatile assets like Pendle as a benchmark. But listen, whether you are trading crypto, altcoins, Bitcoin, or gold, entering all your capital at once is incredibly dangerous. Professional traders don't do that. They look at the chart, identify key structural zones, major support and resistance blocks, and map out exactly where they're going to deploy fractions of their capital if the asset retraces. They never just guess. They look for overlapping confluence, a volume node here, a Fibonacci retracement level there. They're mapping the exact coordinates where adding to the position makes high probability sense. Now, this is absolutely crucial. Holoprime utilizes a super disciplined strategy of adding to the position in 20% steps. By breaking your total intended risk into much smaller, calculated percentages, starting with an initial 20% allocation, you maintain tremendous purchasing power if the asset drops to a deeper support level. You haven't blown your capital, you've actually calculated for the dip. Think about it. If Bitcoin makes a sudden 2% flush down to a lower trend line, a single entry trader is totally panicking. But the trader who only deployed 20% initially, they are calmly waiting to fire their next predefined allocation. And here is the real magic. Even if your first entry dips, your later buys push your overall average entry lower. Sure, your first entry might be a bit high, but your second entry catches the candlestick bounce perfectly off support. That resulting lower average means your break-even point drops significantly. So when the market turns around, say Bitcoin bouncing off a major moving average, you are in the green way sooner than the trader who went all in at the top. You effectively dragged your entry price down to meet the market. This dramatically reduces the distance the asset needs to travel for you to reach profitability. This before and after dynamic is exactly how professionals manufacture an edge in the market. All right, let's move to section 4, managing risk and volatility, because obviously protecting your capital is priority number 1. Now we have to talk about the dark side. Averaging down blindly is a remarkably quick way to liquidate your entire account. Tasty Live heavily emphasizes establishing invalidation points to create binary clarity on when a trade is just truly dead. This is the absolute core of risk management. You never, ever blindly average into a losing trade just because it's dropping. You cap your total risk exposure beforehand, you only buy at structured levels, and if the price breaks your ultimate invalidation point, you cut the entire position. Done. Also, as you scale, your stop losses must adjust dynamically. If gold breaks below your macro support zone, your thesis is wrong. You don't scale into a broken thesis. You take the calculated loss and you move on. But when done correctly, this framework completely shifts your perspective. Scaling in lets you use volatility to your advantage. The noise, the sudden drops, those wild wicks that constantly shake out amateur traders, these become the exact mechanisms that fill your secondary orders at massive discount prices. You stop fearing volatility and you start farming it. When you have structured bids sitting patiently at lower support, a volatile spike downward isn't a heart attack anymore. It's a fill. It's literally an opportunity. And finally, section 5, the psychology of scaling. Let's look at how this creates emotionless execution. When your steps are planned out before the market even opens, the anxiety of pulling the trigger basically vanishes. According to Tasty Live, pre-planning your size allocation completely removes the emotional weight from your execution. You don't have to sit there staring at your desk, debating whether a dip is a trap or an opportunity, because you already made that decision logically hours beforehand. You simply let the market come to you. You aren't making split-second, adrenaline-fueled choices. You are just executing a pre-written script based on solid technical analysis. Visualizing your trade as fractions of a total position pie is a real game changer. It completely eliminates the all-in mindset. By allocating just 20% at the initial signal, keeping 40% in reserve for the first support level, and saving the final 40% for a deeper secondary support, you are pacing yourself. If it never hits those lower levels, hey, you caught a runner with 20% size. Not bad. But if it does drop, 80% of your capital is waiting to secure an incredible average entry. This method beautifully bridges the gap between the fear of missing out and the fear of loss. You participate early, but you reserve the bulk of your strength for the highest probability zones. And as TradeStation points out, you apply this exact same emotionless structure to exiting your trades. Just as you scale in, you gotta scale out. As a trend develops favorably, you automate your strategy to exit fractions of your position. You pay yourself, lock in those profits, and leave a trailing runner to take advantage of unexpected, massive price runs. It completely protects your downside while leaving your upside entirely open. You might close 50% at the first major resistance block, move your stop loss to break even, and just let the rest ride the momentum. It builds absolute confidence. So as we wrap up this explainer, I really want you to think about this. Do you prefer the simplicity of single-entry trades or scaling into positions for better confirmation? Think about how your equity curve might change if you stopped trying to predict the market's every single move and started actively structuring your participation in it instead. It's a massive shift. Keep analyzing, stay focused, and I'll catch you next time.